Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Let's get to our guest. Lucy Baldwin is with us. Lucy is co-head of research and equity advisory at Citi. She joins us via Zoom from Hong Kong. Thanks for being with us, Lucy. Can we start with the Fed? I'm curious about the extent to which you weight the Fed in a lot of your thinking about where to put money to work. Is the Fed still in the driving seat for global markets these days?
Good morning. Thanks for having me. Yes, absolutely. As you say, it's all eyes on the Fed as ever, albeit I don't think this meeting is necessarily as critical for markets as the ones that will come as we head towards June, July. Our view here is that the Fed is still very important because obviously the market has been incredibly focused on two things, AI and on these rate cuts. And of course, the data that we've had at the start of this year has suggested that this last mile of inflation to bring down to the 2% level is incredibly sticky. And so everyone is wondering whether the data we've seen is a red herring or indeed a red flag. And our view here is that it is still pretty hot, the US market, and that actually, it's going to be too early to see a cut. We expect to see cuts coming through in June. As you point out, that's very much the consensus now. But we actually have 125 basis points of cut this year, which is clearly not what the market is pricing, because we still believe that the US will go into a recession, albeit a relatively short and shallow one.
Wow, that's surprising. I've been surprised myself that almost nobody talks about recession anymore, but you're still holding on to that. What do you think is what will be the cause of that? What will be the trigger?
Yeah, absolutely. And as you say, we went from it being absolutely consensus last year. Everyone thought there was going to be a recession. There wasn't. Everything was much better, much stronger. And our view is really that the tightening impact has just been extended, that lagged impact, because people obviously and corporates termed out their debt. We still expect to see that impact coming through. We expect to see services demand weakening. We think the fiscal impulse is a lot less now, despite going into the election. And essentially, we feel that the loosening of the labour market is required to bring inflation back to the 2% level. And we think it plays out one of two ways, either the conventional reduced demand for labour, leading to rising unemployment and a recession, or the more optimistic view, and the soft landing folks believe that supply of the labour market is going to help us out, and you're going to see better participation, more migration, wages coming down, and that's enabling then this soft landing rhetoric. But our view is you are starting to see some cracks emerge in the US, and households and SMEs in particular are seeing balance sheets coming under pressure, eroding a little now, higher rates coming down, quit rates coming down. We think that suggests that payrolls are going to get a little bit softer as we head through spring and towards summer.
So if that's your view on the macro, I'm curious as to how that would translate into equity market strategy. Can you help me kind of square that circle?
Yeah, and it's complex. So our view on the equity market, we get asked a lot, is there oxygen above 5,000? Our base case is 5,100 for the S&P. Our bull case has been, since December last year, 5,700. But to get there, you do need that Goldilocks scenario, right? You need soft landing. You need the US 10-year to come down. You need earnings to be stronger than expected. In fairness, the tech-driven rallies that we've seen with tech now being 20% of earnings, 30% of the index, and more than half the performance, and even more than that last year, that is rooted in some good fundamentals. So there is a scenario to get us to 5,700, but nonetheless, our base case isn't that. We're kind of at the base case now. Valuation is clearly pretty extended. 90% of history, the US market has been cheaper. Now, despite me saying all of that, I don't think people should sell their exposure to the US equity market. It's much more important your time in the market than your time to the market, particularly for most people. Of course, some of our hedge fund clients that are much more focused on daily or weekly performance, it's different. But for most people,
But
it's really important to stay invested. So our view is you diversify a little bit, you broaden out, go a bit more global, you hedge a bit, and we do expect to see less market
Lucy,
broadening out.
We have seen that actually. I mean, we've seen a really nice rally in the All Country World Index, which is all the stocks out there across the globe, has rallied about 25% since November. That's an example of how we are seeing a little bit of a spreading out, a rotation. We've seen materials rally, industrials rally, and energy has rallied. Is it possible that some of the money just comes out of the the big mega cap tech performers and flows into that, and that's a sign that you're wrong? There's no recession coming, that cyclically we're going to go into a steady period.
Yeah, look, I think it is very, very finely balanced whether you do or don't tip into that technical recession, in our view, in the second half of this year in the US. We're shifting to a slightly new global macro paradigm, right? Post GFC, it was all about demand. It's now been much more about supply side issues, and everybody's shifting to the new model, right? The focus is on tech and AI, on life sciences, and on the green energy transition. But the tech AI piece, is still a big question mark. There's going to be a lot of capex spent, and we're going to have to see what that does to productivity. But I think in the near term, the people that are in the bubble camp, you need a barbell strategy to prepare yourself for this, and you need to own some of that tech, but you need to position that alongside the more value options.
We'll leave it with the barbell strategy. Lucy, pleasure to have you on the program today. Lucy Baldwin from Citi here on Daybreak Asia.
Legislation that was passed, the security legislation here in Hong Kong. It's known as Article 23 because it was mandated by the Basic Law, which is the mini constitution here in Article 23. The bill was fast-tracked through the Legislative Council in just 11 days, and it was passed unanimously. Rebecca Choong Wilkins with us, Bloomberg Asia government and politics correspondent. Does rubber stamped come to mind?
Well, since the Hong Kong government and Beijing effectively forced out much of the opposition in response to the pro-democracy protests in 2019, actually, it's not just this specific legislation, but other forms of bills that have moved through LegCo much faster too. Although it is worth saying that experts and certain analysts have expressed concern over the pace at which we have seen this legislation ushered through. It even appeared that after Chinese authorities expressed a desire to get this done, certain Hong Kong lawmakers returned to Hong Kong early from the NPC, that's China's annual parliament, in order to get this through and rush it through these snap meetings.
The voice of Stephen Roach, I mean, he is well known in the financial community, the economist and former chairman of Morgan Stanley Asia. He has long been known for his optimism around Hong Kong, but recently in the FT he said, it pains me to say that Hong Kong is over. When you look at the effect of a move like this on the business community, Rebecca, does it not foster deep pessimism?
I think there's sort of probably two prevailing thoughts. And the first is that in some ways, because Beijing's imposed national security law actually has already been in place in Hong Kong for some years, to some extent, the businesses that are still in Hong Kong, both domestic and multinational, have already become accustomed and perhaps have already adapted to the new realities of a different national security landscape. This also comes amid concern, for example, investors were spooked by a wider espionage, anti-espionage law in mainland China as well. And we have seen firms here, for example, moving to ring-fence data and so on. So there has already been, to some extent, this sort of this process of adaptation. But I do think in other corners of the business community, there is this desire and somewhat perhaps even frustration with the government for continuing to talk about national security. Of course, they had to pass Article 23 in terms of how it was mandated under the Basic Law. But this sort of continual discussion around national security has drawn a lot of criticism, as we've seen from the UK, the US, and so on today. The American chambers in Hong Kong, for example, the top answer from its respondents on what would improve relations and the environment here is if the US and the Hong Kong government would just stop talking about national security.
To what degree have we seen investors get spooked over, like, for instance, the collusion with foreign powers? I mean, that is so vague, the way that it's defined. Are we actually hearing from foreign investors that they will go?
Well, quite frankly, I think a lot of foreign investors is understandably quite cautious about talking about this topic in the first place. But we have heard sort of this anxiety expressed through certain analysts and experts around precisely what this means. And it's perhaps actually the sort of diplomatic figures that have been somewhat more explicit about the risks here. Now, lawmakers, during some of the debates that we saw and the discussions that we saw around Article 23 in recent days, have stressed that if you're just sort of conducting your normal business, not quite sure what that means, but if you're conducting your normal business as a foreign firm and interacting with foreign entities, you don't have anything to worry about. But of course, it is the vagueness that is concerning people. And as the EU has pointed out as well, they're also seeing these sort of significantly increased penalties in the bill, as well as an element of extraterritorial reach that is also perhaps worrying.
So when you look at the local economy, I understand that because its reputation as a financial center has really been maybe cast a little bit in doubt as a result of some of the moves that we have seen since 2019. What can the local economy withstand if there is a move away on the part of let's talk about the financial industry, maybe to reconsider its presence at the same level at which it's been operating, maybe to relocate, and I know we've been talking about this over the years, to a place like Singapore, for example? What would happen, or what is happening, to the local economy?
Well, I think this is precisely the sort of pressure and perhaps the opportunity that Chief Executive John Lee is now looking at, now that he's cleared the path. Article 23 is the last major bit of national security legislation that really he had to sort of get done. But I think there is this pressure to think about what is Hong Kong's status as an international financial center? What does that actually mean? Bloomberg Intelligence produced a report that showed that we see more multinationals, including Chinese firms, wanting and moving to set up their headquarters in Singapore. So in that regard, Hong Kong is already on the back foot.
You talk about a chilling effect. In the past, when we had elections here in Hong Kong, normally the breakdown was usually 60% would go to pro-democracy candidates and 40%. And the way that the elections were set up, the Democrats, they could not actually gain a majority in the legislature because of the way that it was set up with functional constituencies, and only a portion were geographical votes. But you got the flavor of how people felt. Now, Hong Kong Security Secretary Chris Tang tells us that this law had wide support locally, with 98.6% of public feedback supporting this legislation. What does that tell you?
Yes, that has been the government's line. They produced this public consultation that showed these very high levels of support. I will say in that document, they did include some quotes and some elements that expressed more concern, that did express this worry about the vagueness of the law, the harshness of the penalties, this issue around state securities and foreign interference. So we have heard those concerns expressed from some corners. But yes, if you're thinking about the sort of chilling effect, you can see that perhaps that we are already seeing signs of that has been expressed.
We're already there. Rebecca, thank you so much for joining us here in our studios. Rebecca Choong Wilkins, Bloomberg Asia government and politics correspondent. Joining us now is Enda Curran, Bloomberg News global economy reporter. So, Enda, the Atlanta Fed GDP now has growth tracking at about 2% or so. And we know that disinflation has stalled a little bit here. So it does kind of frame the question. Sticky inflation, fairly solid growth. The markets at the moment seem okay with that. Is the Fed?
And don't forget the hot jobs market, Brian. Several there were forecasters not so long ago expecting that the Fed would be cutting rates tomorrow. Well, those forecasts are well and truly dashed by now. And to your point, we seem to be in this narrative around whether or not the disinflation story has stalled. Inflation since the beginning of the year, the first couple of months of the year in core parts of the services sector, like car insurance, for example, have proven to be much higher than anticipated, or at least stickier than expected. All of that is raising question marks around the Fed story. Now, tomorrow, they're not expected to cut rates or change policy, but it's going to be all about what will they signal in terms of when they think the window will come. What will they signal in terms of how they're looking at the latest inflation numbers? Are they looking through it, or are they more concerned? And, of course, we'll get their new forecast. The first time we have had a forecast since December, we'll get the so-called dot plots, and that will give us an inkling in terms of how many cuts those people on the FOMC board are expecting by the end of the year.
Yeah, and I'm wondering whether there's a bit of danger here that the Fed may switch the outlook from what had been previously anticipation of 3 cuts at 25 basis points a pop down to 2 cuts. Do you think that's a possibility?
Can't be ruled out, Doug. I mean, the Fed narrative has already evolved quite a bit since the beginning of the year. As I said a few moments ago, I mean, some people were expecting tomorrow. Goldman Sachs, for example, were originally forecasting tomorrow would see a rate cut. We've already come a long way since then. So most economists are probably still settled on 75 basis points of cuts by the year end. That would probably be 3 incremental moves. It probably would be a surprise if the Fed gives up on that, because it would indicate that perhaps they're more worried about the inflation story than broadly thought. But I think everybody watching this tomorrow will be saying the same point, that ultimately inflation has proven more durable than thought. The jobs market remains very strong, and the overall growth picture is okay. So it's not like the ingredients for the Fed to cut in the near term are necessarily there right now.
On the disinflation story, we do hear claims that shelter is actually coming down, but it takes a while to get reflected in the data, and that it's only a matter of time. I know you study this. What can you add on that front?
The gauging or the measuring of shelter costs here has become a very thorny topic among economists. It was the subject of a lot of confusion, as you know, earlier this month and last month, with the Bureau of Labour Statistics giving a briefing on how they do gauge it. I think to your point, Brian, the broad narrative among economists is that shelter or rent has stabilised and is expected to come down and take the sting out of inflation in the months ahead. But again, that's proven to be more resilient than expected. And that goes for other parts of the core gauges of the economy as well. You see things like airfares going back up. You see used car prices. You see, as I mentioned earlier, auto insurance. There are plenty of subsectors of aspects of everyday living that continue to push in the wrong direction. So regardless how you slice and dice the data, I don't think anyone here could confidently say that the broad inflation story is well and truly over. And remember, the Fed keeps saying they need to be confident that inflation is coming back to the 2% target. They've repeated that word confident several times. I don't think anyone can say they can be truly confident given the January and February inflation data.
There's been so much anticipation of this pivot toward easing that I think financial conditions, I think we may be able to agree on this, they're much looser now, perhaps a little more than the Fed would like to see. The equity market very near record highs. We've got yields coming in just a bit. Do you think this is going to be troubling, the condition of that financial conditions are in right now?
It's a fair point, but, I think, there is pain at the margins of the economy. We know that there is some softening in the jobs market, for example, undoubtedly. We know that there's stress on, we'll say, people with car loans, people with credit cards. We know that there's pressure on small business loans. So, I don't think the Fed will be totally averse to an easing of financial conditions. And that's why a lot of people think that ultimately they will be easing this year. It's a question of by how much. The thing to keep an eye out for tomorrow on financial conditions is what they signal on the balance sheet. Remember, they have been shrinking their balance sheet passively. They don't want to do that to the point where it starts to create market stress and tighten conditions, to your point. So listen out for any new commentary on the balance sheet tomorrow.
I think the easing of financial conditions, one thing that has changed that is probably good news to the Fed is that the market has come around to its own point of view, basically on around 3 cuts this year. And the Fed doesn't want to get involved in telling markets, how you value stocks. But it doesn't feel comfortable when the market is thinking there's going to be 6 or more rate cuts when they're only thinking about 3. So I think your point is quite good that the Fed may not be too concerned about financial conditions at the time. But and the difference between 3 rate cuts and 2, I'm interested in you explaining, and what's the mechanism for that to be felt in the economy? Who does that hurt? What does the math say about how it hurts earnings or business itself?
So if you consider that the Fed is currently well into restrictive territory, that's the jargon for saying interest rates are really high and, causing pain in the economy. 1 rate cut won't change that. 2 rate cuts won't change that. And maybe even 3 won't. And that's where there's a big academic debate going on in the background in terms of how many or by how much would the Fed need to lower rates to get it back to where it's in this so-called neutral zone, whereby it's neither hurting the economy or necessarily stimulating things. So for sure, some rate cuts would obviously take pressure off the margins. Those people on floating rate loans, be it credit cards or maybe if it's a car loan or whatever, of course it would take pressure off the margins. But I don't think people would necessarily say it would be game changer, and that's because and that's where this whole neutral debate comes into it in terms of just how far does the Fed have to cut before they're really taking their take the pressure off the economy. I should say though, let's not forget this is where you also bring up the other side of the debate, which is that the cardinal error of central banking is cutting rates too soon, only to see inflation resurge. So it's going to be a tricky one for the Fed to try and ease when they can to take pressure off those pockets of the economy that are hurting, but of course without letting inflation run wild again, as central banks have made that mistake in the past. So this is a very difficult act for the Fed.
Talking about difficult exercises for central bankers, can we talk about this shocking decision from the Bank of Japan? I say that tongue in cheek. I mean, the Nikkei had really been out in front of this story in a big way here, and pretty much the BOJ delivered on what the Nikkei had reported. I'd like you to weigh in on just not only what you heard from the Bank of Japan, but the way in which the market responded. You
would have to say textbook delivery of how not to surprise the markets with a policy move. I mean, as policy moves go, that was as dramatic as they come. The Bank of Japan hiking for the first time since 2007, pulling out of negative territory, scrapping the ETF purchases, dropping YCC, and the markets, broadly speaking, took it in their stride. And the fact the yen softened a touch, which is a great result for the BRJ, given they don't want to inflict any pain on their exporters. So, look, they got the message out there. They communicated it. In the end, it clearly wasn't a surprise to investors or to markets. In terms of where they go from here, though, is a much more open question. I think I've seen people call it a dovish hike by the BRJ. Governor Ueda seemed to be stressing that policy conditions are still fairly accommodative in Japan. It's worth remembering that they are still supporting the economy. The official rate's in a range of 0 to 0.1% now. So, yes, it's a dramatic move, but the question is where to go from here.
I was a little surprised that the BOJ didn't hint a little bit at future rate hikes. And the market seems to have interpreted this as one and done, hence the drop in the yen. And one of the things that we hear is that average Japanese people are unhappy with levels of inflation, and a weaker currency will make some things more expensive.
That's right. It will certainly make tradable inflation more expensive, and not least oil, of which Japan is a big importer. And Ueda did mention in the remarks I was reading this morning, he did give a nod to what's going on with wage gains and with inflation. So clearly he said they're going to watch that closely. So he certainly did not signal another near-term interest rate hike, but neither has he ruled it out. So I agree, Brian, the takeaway seems to be more or less one and done for now, but that narrative could change as the months go by.
Well, we gave you the latest numbers here. Dollar yen at the moment, 151.27. We won't have any trading in equities in Tokyo today because it's a holiday in Japan for the vernal equinox. But Enda, thank you so much for joining us. A great discussion. Enda Curran, Bloomberg News global economy reporter.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.